Hi there, this is Nathan. Today we're talking about how I feel the stock market will react in July of 2021. Given that we have just received news from the Federal Reserve, we roughly know how the Federal Reserve feels about the US economy. As most investors agree that the Federal Reserve is on the side of the stock market, investors could only care about inflation. However, as most investors believe that inflation is temporary and it's off the table, the stock market should go higher. The question is how high the stock market could go before it comes down. So in this video, we'll be talking about how I feel the stock market will react in July of 2021. Before we continue, please smash like button. And if you'd like to see more such videos, please subscribe to this channel. Firstly, we'll be talking about the reasons why investors feel the stock market could go higher. The first reason we're talking about is that the Federal Reserve is on the side of the stock market. The Federal Reserve, which has played a big part in confusing the market, may be helping to clear things up. What happens to the argument that inflation will blow up bond yield? So far, it has been won. With bond yields lower and not higher, the bond market is signaling it's more worried about weaker growth, not inflation. And the Fed is the cause of that. A lot of apathetic investors are twisting themselves into pretzels these days, trying to understand what is going on in the market. Inflation hawks are having a tough time explaining why now that the Fed has finally upgraded its inflation expectation. Bond yield has been dropping. Various stocks such as banks, industrial commodity stocks and other cyclical names who have enjoyed 5 months of outperformance after years of lagging the market are apathetic that the market is selling off commodity stocks as fast as they can. And technology and growth investors, particularly those in speculative growth stocks championed by Cathie Wood and others, are delighted as her flagship fund, ARK Invest ETF, is at its highest level since early May, after getting pummeled from February through April. Others, however, are hopeful some of the confusion may come to an end. So why are there traders who are confused? Are bond yields trending up or down? Should we buy cyclical stocks or technology stocks, or defensive ones? Is the economy still on tear that is going to last into 2022, or are we cooling off fast? Is inflation such a problem it is going to become 1974 again? Or is it going to become perfectly manageable in a few months? It's understandable everyone is confused. The shock of COVID, the sudden burst, and the sudden subsequent boom, combined with massive liquidity from the Federal Reserve, has confused everyone on where we are in an economic cycle. What is the issue without knowing which cycle the economy is in right now? If the economy is still in an early stage of economic expansion, investors will typically buy cyclical and bank stocks. If the economy is in the middle of recovery, in which growth and earnings are still strong but beginning to decelerate and interest rates are still low, investors will typically favor technology stocks. If the economy is in a last cycle phase, which is characterized by higher rates and high inflation and high price-earning ratios, investors will typically favor defensive stocks such as consumer staples. The problem is, no one is sure what part of the economic cycle we are in. That is why we go up and down and in and out of different sectors every day. How does the Federal Reserve fit into this trade? Perhaps the Fed, with an effort to aid the economy that created much of this confusion, can help bring more order. The number one driver of the market has been monetary policy. The ocean of liquidity provided by the Federal Reserve created an enormous economic boom that argued for buying value over grown That approach was successful through the first 5 months of this year. Now that is reversing because the markets believe that the Fed will slow the economy in 2022. So bond yields are going down because of fear of slower growth, as cyclical stocks like Caterpillar, Freeport, and US deals are getting cut. Investors are going back into dependent growth known as technology names that's less dependent on the economic cycles. Clinics will argue that this is just the narrative for the moment that could change on a dime. But the Fed, which created much of this confusion, is now acting in a manner that is causing traders to map out a clear economic scenario. It is one of still strong growth but with less monetary accommodation and slightly higher stock terms rate sometimes next year. The second reason is that there could be a new infrastructure bill which could boost the industrial stocks even more. The bipartisan Senate infrastructure deal, which costs around $1 trillion, a price that leaves the Senate with work to do to win over members of both parties. The proposal, which aims to upgrade physical infrastructure such as transportation and water system, would cost $974 billion over 5 years or $1.2 trillion over 8 years, a source familiar with the plan told CNBC. It will include $579 billion in new spending above the baseline already set by Congress. Biden asked for around $600 billion in new money, according to Senate Bill Cassidy. Senators have not announced how they plan to pay for the investment. The proposal will be fully paid for and not include tax increase, the 10 lawmakers which reached the deal said in a statement. The group framed the proposal as a compromise to upgrade US infrastructure with bipartisan support in Congress. The Senate still needs to win backing from President Joe Biden and congressional leaders for the plan to gain traction. In a statement, White House spokeswoman said, quote, questions need to be addressed particularly around the deals of both policy and pay force among other matters. The White House let Senate know it will not agree to pay for a bill by either indexing the gas tax to inflation or implementing an electric vehicle mileage tax, NBC News reported. The message will break Biden's promise not to raise tax on anyone making less than $40,000 per year. It is also unclear if the spending will be broad enough to win over Senate Majority Leader Chuck Schumer, House Speaker Nancy Pelosi, or progressives who have grown impatient with Biden's effort to reach a bipartisan deal. While Senate Minority Leader Mitch McConnell has said he wants to pass a bipartisan infrastructure bill, he also signals his aim to block major pieces of Biden's economic agenda. Schumer's and Pelosi's office did not immediately respond to requests to comment. A spokeswoman from Mitch McConnell did not immediately comment. Democrats are working on more than one front to pass an infrastructure bill and implement the first piece of Biden's economic recovery agenda. While the White House considered the bipartisan proposal, Democrats have started to set the groundwork to pass pieces of the president's $2.3 trillion American Jobs Plan by other means. One tool is a 5-year, $547 billion surface transportation funding bill advanced by the House Transportation and Infrastructure Committee. Democrats could use the measures, which the House could vote on as soon as the end of the month, to approve parts of Biden's agenda. It is unclear whether the Democratic leaders will accept the bipartisan plan's lack of spending on so-called human infrastructure, such as Biden's plan to expand care for elderly and disabled Americans. the parties could potentially weave those proposals into a separate bill based around Biden's American Family Plan. The proposal will focus on childcare, education, and healthcare. President Joe Biden expects to meet with lawmakers as a group of Democrats and Republicans try to forge an infrastructure plan that could get through Congress with bipartisan support. White House Press Secretary Jim Psaki said at least 21 senators from both parties have backed a framework that seeks roughly $1 trillion on transportation, broadband, and water system. Biden and Democratic congressional leaders have raised questions about how lawmakers plan to pay for the plan, with liberals have called it inadequate to fight climate change. The president's talks could mark a final push to find a compromise before Democrats try to pass a sprawling infrastructure plan on their own. While the discussion between Democrats and Republicans go forward, Biden's party has started the progress of drafting a budget resolution that will allow them to pass a bill without GOP votes. Biden initially called to hike the corporate tax rate to 28% to pay for his $2.3 trillion infrastructure plan. Disagreement over how broad the proposal should be and how to pay for it threatened to tip up the bipartisan plan in the Senate. Senate Bernie Sanders, a Vermont independent who considers with Democrats, said he will not support a higher gas tax or an electric vehicle mileage fee as part of an infrastructure bill. To pass the deal through, White House negotiators and a group of Senate slashed measures to combat climate change. The narrow infrastructure deal leaves President Joe Biden's proposal on climate change to a separate bill that Democrats could attempt to pass through Congress using reconciliation, a process that does not require Republican support. The second package could also include programs related to child and elder care, education, and healthcare, in addition to climate change measures, issues that administration officials have called inhuman infrastructure. The estimated elimination of climate measures in the plan comes as the world grapples with the effects of climate change, including worsening disasters like hurricanes, wildfires, and droughts. And scientists urge that immediate action to slash greenhouse emissions is critical to avoid the worst consequences of global warming. The bipartisan bill includes just $15 billion towards electric vehicle infrastructure, electric bus, and transits, a small fraction of the president's initial proposal to spend $174 billion on boosting the transit. The prospect of massive major climate legislation through Congress was a long shot from the beginning, but Democrats have been fighting to keep the president's climate measures in a bipartisan bill. The last major push to pass climate legislation was in 2009 when congressional Democrats failed to approve a carbon pricing system under former President Barack Obama. Many Republicans have long argued that infrastructure bill should only address traditional transportation issues, while Democrats have sought to include climate provisions among other measures. Ultimately, negotiations for a bipartisan deal have led to a slimmed down version of President Joe Biden's first plan. The president's original plan also proposed an energy efficiency and clean electric standards that will require some US electricity to come from zero carbon sources like wind and solar, and includes investment for research and development on climate change mitigation technologies like carbon capture and storage. Such measures would aid Biden's commitment to cut carbon emissions in half over the next decade and put the US on track to becoming carbon neutral by 2050. Secondly, we'll be talking about the main reason why some investors feel the stock market could come down in July. Even though there isn't much, some investors still feel they have a 2-year shot clock to profit from the growth companies before the rise in inflation will kick in. On top of that, they do not know if the Federal Reserve will bring forward the rise in interest rates. Given that the oil prices are still climbing, this might give some investors more reasons to push the Fed to raise interest rate early. Hence, as this fear continues to affect the stock market, this could seriously affect the plan of growth investors. Moreover, the June non-farm payroll is coming out very soon. Investors feel that there is a chance for a rapid rise in inflation. They will come out and say that inflation is not transitory and the Fed has misinterpreted the current situation. This could push the stock market lower. The dollars fell, consolidating recent gains that pushed it to nearly 3-year highs during the first quarter. But the outlook remains upbeat in the wake of improving economic prospects backed by the Biden government's more than $2 trillion stimulus plan. Investors are now looking to Friday's non-farm payroll report to confirm their positive view on the dollar and economy. Meanwhile, US data shows strong growth prospects. A report on the US manufacturing sector showed a stronger than expected reading of 64.7 in March, the highest in more than 37 years. That was offset though by slowing construction spending, which fell 0.8% in February, and an increase in US jobless claims in latest weeks. A report on US manufacturing sector showed a stronger than expected reading of 64.7 in March. Sentiments towards Europe though received a boost when data showed Eurozone's manufacturing activity growth galloped at its fastest pace in the nearly 24 years history of a leading business survey. Finally, we're talking about how I feel the stock market will move in July of 2021. Given that there are a lot of reasons to push the stock market higher, I should side with the bull investors. However, the bear traders have a point. The June non-farm payroll showed that there's an increase in the number of people getting jobs, but little growth in salary. That could be fear of a one-way inflation. Just like how in 2016, the Fed had to come in and slam the brakes by raising interest rates. It may happen again, until we can prove that there's a rise in salary to match the rise in commodities. There are still headwinds surrounding the stock market, hence I'm still on the fence. In conclusion, I strongly feel the stock market will trade sideways, and investors decided which side they should invest in. The stock market will move up and down. Unless there's a confirmation that inflation is transitory, there will be little to no change in the stock market. However, it will be extremely volatile. With that, thank you, have a nice day, goodbye.